Today we would like to review the US Federal Reserve's interest rate decision. Yesterday we had the announcement from the US Federal Reserve on its latest monetary policy decision. Now, looking at the Federal Reserve and comparing it to other major central banks, it has a slight difference to, say, something like the Bank of England, where the Bank of England just has a mandate to focus on inflation, whereas the Federal Reserve in the US has a dual mandate where it has to look at inflation data, but also how the employment market is faring. So with that in mind, we'll review how both of those components are looking going into this meeting. So starting first with the inflation component, we know that inflation in the US has re-established itself on its disinflation trend, where we see prices fall but stay positive. As we know from previous videos we've discussed, Q1 inflation data in the US was slightly higher and stickier than what both markets and the Federal Reserve had been expecting. But the data that we've seen play out since has shown that that disinflation trend is still there. So looking at the Fed's preferred inflation measure of PCE inflation, that's at 2.5%, so roughly 0.5% higher than what the Federal Reserve's target of inflation would be. And then looking at the second component in terms of the employment market, employment in the US, or unemployment in the US, has been rising slowly over this year. So at the minute, we're at 4.1%, which on a historical basis is still very tight for labour markets in the US. But in this post-COVID economy, that's the highest level of unemployment we've seen since 2021. So with that in mind, we'll examine what the Federal Reserve did. So in terms of how they actually changed interest rates, well, they were unchanged as announced in the meeting. Now, this came as no shock to markets, as they'd only placed a small probability of roughly 5% that the Fed would cut rates yesterday. But as we normally comment on these videos, it's not just the actual actions that the central bank make, but it's the comments that they follow up with afterwards in the press conference that are interesting to financial markets. And if we just think about what Chair Powell had said after the meeting, he talked about how the balance of risks between that dual mandate that the bank has between inflation and employment is now starting to become more balanced, where previously the bank was just focused on the inflation mandate. The comment that Powell made is that the labour market is now seeing downside risks that are now real. So they're starting to think about the risk that unemployment continues to rise because of where high interest rates are. And pulling that all together, that has led the bank to announce that come September, should we see the inflation data remain lower than where it has been previously, that a rate cut could be possible in September. So thinking about what that means for financial markets, well, the market's now pricing 100% probability that we see a 0.25% cut in interest rates in the US. So that would take us from the current rate of 5.25 to 5.5 down to 5 to 5.25. So thank you for watching today's video. Please come back tomorrow where we do our week in review of this week on Friday. And if you could like and subscribe to the True Potential YouTube channel. Thank you very much.